We have three distinguished panelists, and their names are probably going to come up on the screen, but their bios are in your on the website. So we have the pleasure of having Sally Green, Felix Ho, and Shivan. And did I get that right, Shivan? Perfect. So what we're going to do is try to talk about three different aspects of corporate governance. And we define corporate governance pretty broadly to include all processes and tools by which shareholders and boards hold management accountable. So we're interested in sort of the results, not processes for their own sake. So what we're going to do is have each of the panelists talk for about 5 minutes, and then we'll have a little discussion among the panelists, and then we're going to leave 20 minutes at the end for questions from the audience. So you can save up your questions for that. So we're going to organize the session as follows. Sally is going to begin and talk about the nominating committee, including how you get on boards and diversity, independence. And then Felix is going to talk about some of the big picture issues about strategy, allocation of capital, short-term versus long-term. And then Shivan is going to talk about the non-controversial topic of CEO compensation. And the latest wrinkle on that, the ratio of CEO pay to median worker pay. So without further ado, I'm going to turn the floor over to Sally.
So you can see Shivan drew the short straw here. Welcome, very happy to be here to talk with you, and happy to talk with you after we're done too. I'm going to make just some general remarks about the roles of boards of directors and what that implies for the types of individuals you need to have on boards, and those general remarks, those characteristics would apply no matter what board you were on. Then we're going to ask ourselves 4 questions to talk about how you get onto boards. So I'll cover those questions when we get there. So what's the role of a board? Is it to manage the organization? And it is not. All of you know that. It is to oversee the management of the organization and ensure the execution of the strategic plan. And clearly, the board is representing the various stakeholders that have an interest in the bank, the shareholders, the employees, the clients. So what does that imply? So a couple things you need on your board. You need actively engaged directors. So directors who are going to prepare, they're going to spend time, and they're going to take a significant interest in the organization. You need directors that will work well together and that respect each other's different backgrounds and expertise, and that will ask insightful questions of management. And sometimes, support management in its role of executing on the strategic plan, but also sometimes push back on management. So directors that are not reluctant to do that, that's important. And finally, any board is going to reflect the type of institution that it is serving. So, and also, it's got to reflect the strategic plan. And that's critically important. It seems incredibly obvious, but it isn't always true that you've got directors with the right kinds of skills to make sure that that strategic plan gets executed. So Cambridge Trust Company, I see our names are up there now. It's a $2 billion financial institution with $3 billion in wealth management assets, and it has, it sits here in Cambridge, in Greater Boston, and in New Hampshire. My other board, Child Fund International, is a very large NGO, nonprofit, that serves children in 25 countries around the world. And so the types of expertise that you need on both of those boards, there's some similar types of expertise, financial expertise, for example, risk management expertise, but there's also totally different kinds of expertise that's required on those boards, and I'll come back to that in just a second. So those are the general remarks about boards of directors. Now let me ask 4 questions that will help us think about how...
It's like Passover, right?
Yeah. 4 questions that will help us think about how directors get on board. So the first one is, who manages the selection process? So there can be a lot of different approaches. We've used 2 at Cambridge Trust, for example. When early on we needed to get a number of directors fairly quickly. There were going to be a number of open slots quickly. So we had a specially appointed or selected nominating committee that, because it required a lot of time on behalf of those directors. So there had to be a commitment to that time frame. Right now, we're beginning a search for a couple open slots, and the governance committee is doing that because we're well out ahead of when those slots will need to be filled, and it can be managed by the governance committee along with the various other functions and roles of that governance committee. So those are the 2 approaches at the bank, at least, that we've used in terms of managing the process. So second question, who are we looking for in a board search? So first thing is to do a job description, basically, and define the expectations of the directors. Again, this seems incredibly obvious, but you have to be very careful that directors understand how much time they have to commit, when do the committees meet, et cetera, et cetera. So first thing is to do the job description. Second thing is to review the background of the current members and understand what kind of expertise you might lose, and then match that against the strategic plan and understand what gaps you have in expertise, where do you need to deepen the expertise on the board to ensure that the board can really focus on the execution of that strategic plan with management. So that's the second thing. And then, so for example, Cambridge Trust is,
So you finish your last 2.
Okay. So another area, leadership, so looking for C-suite. Next area, board experience. So a point I want to make here is, how do you get on a board if you haven't been on a corporate board? Because boards are looking for board experience. Serve on nonprofit boards. I had a number of leadership positions in nonprofit boards, and it's been hugely helpful as I took the position on the corporate board. And last thing is diversity. We always look at the diversity of our board, and that doesn't just mean diversity of experience and background. It means diversity geographically, diversity, gender, ethnicity. So Cambridge, and this doesn't happen by chance. This happens because you really make it happen. So Cambridge Trust has 50% women on its board, has 2 African American board members, and so diversity is critically important, I think, in terms of representing your shareholders, et cetera. Third question, how do we find these people? So you can have an executive search firm, or you can reach out to your own networks. And I think the latter is the better approach, have the board members reach out to their networks. Each of us would reach out to different networks as long as you have a diverse board. Now, if your strategic plan is taking you in a different direction and you don't have any of that experience and expertise on the board, you may need to supplement those searches with an executive search firm to fill that kind of skill. And the last thing, and I'm going to make it, how do we select them? Well, you get this enormous, huge list from going out to all those networks. And you just start to narrow it down by comparing it with what are the types of characteristics that you're looking for on your board. And then you prioritize, you go do informal interviews, formal interviews, and present your slate to the board of directors and eventually to the shareholders. So
That's a great
Did I
start,
make it?
and you made it, and let's ask a few questions, and other members of the panel may want to chime in. So one thing in terms of the tenure board members, so there are a lot of boards now that have mandatory retirement, often around 72. Seems very young to me these days, I don't know why. Or some boards have term limits. In the UK now, the rule is after 9 years on a board, you're deemed to be not independent. And since most of the committees, compensation, audit, require independence, so that's a big deal if you're not independent. Sally, how do your boards deal with that? What do you think is the best way to deal with it?
Okay, so I have two different answers to those two questions.
Good.
One is Cambridge Trust, you age off at 72. So it's exactly what you were saying. But that means some people are on there have been on there for a really, really long time. And that was only recently put in place. Now, the way I think it's best to deal with it, because you want expertise of people who are still working and et cetera, but I think you also want some people who are later in their careers. And so I prefer a system which we actually used at the Federal Reserve, where I was for a long time, that if you come on, you have a certain number of years that you can serve so that you can go past that 72 mark. Say you come on at 70, which would not be as likely, but if you came on at 70, you'd have a term of 5 years, so you could go to 75. You wouldn't be knocked off at 72, because I think there's some tremendous talent in for us to capitalize on, and you don't want to knock people off immediately.
Yeah, I don't know, 9 years actually doesn't, it sounds like a lot of time, but it isn't for a very large, global, complex company. Probably takes you a few years to really figure it out, and to kick off a really good director after 9 years, I have some real problems with that. Let me ask you another question, a specific question. In Norway, there's a requirement that 40% of all boards be women. And in the US now, contrary to what is true of Cambridge Trust, on average, US boards have about 23% women. So how do you feel about the quota system? Germany has a quota at 30. Or how do you feel about that approach? Or do you think other approaches are better?
Yeah, I don't like quotas, because I think that in hiring in an organization, you should always have a diverse pool of candidates when you're hiring for positions at the top of the organization, but then you should select the most qualified person. And so I don't like the quota system, but I do think that there has, like the Boston Club here in Boston's women's organization, and it's been doing surveys for 15 years now, and calling out what they call the 0 zeros, which are organizations that have 0 women on their board and 0 women in their C-suite, in their management executive management team, and then calling out organizations that are trending in the right direction in terms of diversity. But boards have to make a commitment to diversifying their board.
Okay, so in the interest of time, we're going to go on to Felix, who's going to start by talking about the board's role in setting strategy, and I believe he's also going to touch on the very important role of the board in allocating capital.
So, we're here talking about corporate governance, right? And very simply, corporate governance is the governance of corporations, right? That's pretty straightforward. And what I think is in general, corporate governance has done a much better job than other kind of governance. I mean, look, if you think about your,
Well, when you compare it to Congress, it's a pretty low bar.
but it's the same thing across the world, right? So I primarily am based out of Taipei, Taiwan, and I've served on boards mostly in Asia, even though I've served nonprofit boards here in the U.S. and non-public companies here in the U.S. and the U.K. Governance, I think in general, and I think that's for a reason, right? Because typically there are shareholders involved, and shareholder has money, and you vote with your money. And so I think in general, historically, even though corporate governance has been, a controversial topic in the last maybe 2 decades, I think corporates and boards have done a relatively better job of governance than most governments has. Take that as a thought. So what's the board's responsibility, right? And I think, to one extreme, right? In a previous panel 2 hours ago, it was very simple, right? The board's number one responsibility is to hire the CEO and fire the CEO, right? So you monitor whether the CEO is doing the right job. Is he following the strategic plan? Is he allocating resources?
But we need to, so obviously that is an important role, but the question which other people may want to be interested in your answer is, so what is the role of the board in setting overall strategy? Is that something where the CEO, that's his or her bailiwick, or is that the bailiwick of the board? Who initiates, who formulates? Is the board in the position of saying, well, I don't like your strategy, so we picked you as CEO, but you're a good lady or a good guy, but we don't like what you're doing strategically?
Well, I mean, and so I think there's a gradation of things, right? So there are boards that set strategy and hire the CEO to execute, and to execute only, right? There are boards where the CEO or the management team work closely with the board to develop a strategic plan and to execute that consensus strategic plan. And I think what we need to take note of also is it makes a difference in board makeup and also whether you have significant anchor or strategic shareholders.
Yeah.
That makes a huge difference.
So that's a very important point you're raising. So we need to think across the world where we have a dominant shareholder, a family, or the government. Well, then they're very likely to have a pretty well-formulated idea about what the strategy is going to be, and they're hiring the CEO to execute. But in the typical American Anglo-Saxon board, dispersed shareholders, I think it's fair to say that almost every board in that category I know has a long board session every year just to reevaluate strategies.
Yes.
So that's viewed in your model more as an interactive process.
Yes, and I mean, even nonprofit boards do this. I've sat on the US 501c, and every year we would spend 2 full days, develop and reviewing the strategic plan, right? So there's a whole gamut of different processes at work, right? When you have a very dominant shareholder that say have more than 50% share, that's a very different process because the investor has its investment thesis and the management is brought in to execute that investment thesis.
But let's focus, I mean, that's pretty straightforward. Let's focus on the typical publicly held company where there are lots of institutional shareholders,
Yep.
and they may in the aggregate own 60% or 70%,
Yes.
but each one owns only 2, 3, 4%. And one critical aspect of strategy is capital allocation.
Yes.
Are the profits going to go back and be put into the business, or are they going to be distributed to shareholders either as buybacks, as dividends? this has become very controversial now, especially with some people would say a windfall profit because of the recent tax legislation.
Right, and I personally have very strong opinions about this.
So
I think,
let's hear it.
you know, I think what, you know, sitting out in Asia, right? I think what has been consistently problematic was particularly American capitalism or the American capital markets is, you know, the overstressing of total shareholder returns, right? And in particularly short-term shareholder returns. And this also has to do with how the funds that are participating in the capital markets, right? You know, I've worked in equity capital markets before, right? And you have your typical long funds and short funds, and you have your hedge funds, right? And there are even funds that are specific for quote unquote special situations, right? So basically they invest in troubled companies, try to break them up, unlock value.
Yeah, but even, you know, I once had the unusual experience of Carl Icahn wanted to meet with me. He actually wanted me to tell him how we could take the position that poison pills were unconstitutional. I told him I didn't think that was feasible. But he pointed out to me that his average holding period is 4 or 5 years.
Yeah.
So people think of these activist hedge funds as short term, but really, that may not be a fair criticism.
Yes.
Of course, there are hedge funds that are trading, you know, every minute, every
Yes.
day. But a lot of these activists, and then if you ask where I used to be president, Fidelity or BlackRock, they would say their positions are so big, they can't afford to be in and out.
Yes, yes, and I think there's a lot of different investors, right? So those of you familiar with financial markets, there are all kinds of different investors in the field, right? And unfortunately, there are people who trade on news, and there are people who are momentum traders,
Sure.
right? And those people are looking at short-term performance because then they can either flip up or flip down, right? Short or long. And I think it was just only 2 days ago that Warren Buffett came out and said, "Hey, we got to get out of these quarterly guidance, right?
Guidance,
right?
So it's interesting that we always hear CEOs and CFOs complaining about a short-term orientation. 75% of the companies in the U.S. project their next quarter earnings publicly, and essentially say next quarter, we hope to earn $2.42. So that's not a good way to get people to take a longer-term approach.
And absolutely, right? And you know, I've been CEO, I'm now CEO of my company, and to be honest, the world's changing so fast. There's very little confidence that I can tell you with 100% assurance that, you know, how much am I going to go make next quarter, right? So, for example, you know, what's happening between, you know, the Chinese and the American government right now, that is affecting my company significantly.
Right.
And I don't know my raw material prices next month. So, very difficult to tell you what I'm going to make next quarter, right? Interestingly, where I come from, you know, we have a couple of public companies in Taiwan. And in Taiwan, if you announce a forecast, you have to hit it within, I think, a plus minus 15% range, right?
And what happens if you don't?
You get fined or you get punished, right? And so what happens?
U.S., what's very simple, you say $4.23, and you hit $4.22, and your stock drops by 8%.
Yes. But there's no legal punishment, right? So
Yes,
you're not
correct.
criminally liable. In
Right.
Taiwan, if you have forecast,
Yeah.
you become criminally liable. So what happens? Right? Nobody gives
No
you
one
any
does.
forecast whatsoever. Right? Because no one wants to be criminally liable. Like, you know, if there's a major event that goes on, you know, I have no way of predicting that, right? And so how am I going to be able to predict that?
So Felix, we're going to let you ask one more question. Is talk a little about how you see taking profits, increasing your dividends, buybacks, versus reinvesting them in the business.
Well,
It's a very difficult area.
yeah, but I think from my perspective, and again, this is why I say I have a strong opinion in this. I think shareholders should get a fair return, right? But when you sit on a board, your allegiance is no longer with a specific shareholder. Your allegiance is with all shareholders of the company,
And the company.
and the company, right? And so you're responsible to all stakeholders in the company and shareholders in creating long-term value, right? And we're all Sloan alums here, so you know MPV, right? And you calculate MPV what? By taking all future cash flows, right? But that's not how people tend to look at companies these days, right? And that's why the short-term focus.
Well, even if you take NPV, some companies are good at reinvesting cash flow.
Yes.
Some companies that aren't so good,
Yes,
that's
yes.
sort of true of almost everything, right?
Yes. But I think in many cases now, right, people, all companies are talking about corporate social responsibility, or if you push it a little further, sustainability and social responsibility. And boards are now being mandated, sometimes by regulation, sometimes by shareholders, sometimes by other forces, to do this, right? And so you're not only responsible for shareholder and their return, you're responsible for everyone else who has a stake in the company, right? And so this is how I position my company, and we write this publicly in our annual report, right? So our job as a company and as an organization is to maximize positive impact to society, give our shareholders a fair return, and minimize our environmental footprint in the process, right? That's what we publicly write on our CSR report and on our annual report.
Okay, Shivan.
That's fine. Great, thank you. I thought I'd just tee up executive comp, and then we'll take questions as we go along.
Sure.
First, I'm just going to talk about it more from the perspective of a director, rather than an HR department or management designing a plan. So from a director's perspective, the plan design, what you wanted is to want to be very, very sure it attracts and keeps talent in the organization. And almost always, even though you talk about executive comp, as Bob said, you end up talking only about CEO comp. And in the U.S., you technically talk about the top 5, but in general, when everybody discusses it, it's generally talking about the CEO compensation. So you want to talk about how well is it going to keep and attract talent. Second thing, you want to be very sure that whatever the plan design is, you want it to respond well for both short-term and long-term trends. And more importantly, you want it designed in such a manner that it's heavily based on variable compensation, meaning that the variable compensation part is more designed around performance and performance metrics. So this way, if you do well, it starts to pay off a lot better. And if you do exceedingly well, better than what you expected, it starts to grow exponentially.
How do we define that?
That's the problem. So now the challenge in all of this is what kind of metrics do you use, and for what organization? Some organizations, some metrics are fairly straightforward. I think if you're a single product company, it's fairly easy to design metrics on performance and how you want to measure them. But as you get into larger and larger organizations where there's multiple lines of business, what kind of metrics do you design for a CEO? So you almost invariably end up with very generic metrics, like growth rates or EPS growth or things like that. So the metrics start to become very, very generic. So the challenge to the board is how do you design these metrics in such a manner that it responds well to what the strategic plan says or what you agreed to, and how you want to measure that. So that's one of the challenges. The second challenge is really from a director's perspective is how does a marketplace view, because you're designing a compensation plan, you don't know how it's going to work till it actually works, right? So now a year later or 3 years later, you actually measure Now you're measuring all these metrics, and then you come up with, then you look at how the plan was designed, and you come up with this outrageous compensation. And then you have this hullabaloo that goes on saying, how could you have possibly done that? But if you go back to the design, if it met the design standards, the board almost always doesn't have much flexibility in not awarding the compensation because that's what the design was. So the design starts to become very important. But the challenge always is you're never quite sure. You think on an ex-ante basis you've designed a terrific plan, but an ex-post basis might look horrible. For one very good reason is that you're not quite sure how the marketplace is going to respond to the outcomes of your performance.
So can you reduce that risk by having appropriate peer groups using
Exactly.
indexes?
Right.
And what do you think? There's been a lot of criticism of peer groups where companies, somehow in the financial industry, Goldman Sachs appears as the peer group for lots of companies. So I don't know why, but it's somehow there, you know?
Well, this is where all the consultants come in, Bob. That's where,
Now there's a group of people.
So they come in and they'll come up with all kinds of, nifty little ways of defining peer groups. Now the peer group you start to then have challenges there too. Is that, do you want a peer group that's representative of the product that you make? Or do you want a peer group that's representative of the capitalization that you have? Or what kind of geographical mix you have? So every one of these steps, you've made a calculated gamble actually in what you want to do. What kind of metrics do you want to have? What kind of peer group do you want to have? And then lastly, what's the measurement period? Do you want to measure it over 12 months or you want to measure it over 36 months?
So there's a very important point. People now often defer cash bonuses for
Right.
half of cash bonuses for 2 years so they can claw them back.
Absolutely.
But a lot of bonuses are based on the last year's performance, 1 year. And I think this is really following up Felix's point. If we really want people to take a longer term approach, we should base it on 3 years' performance or something like that.
So I see a trend here is that if you look at the most recent 10Ks that came out, you start to look at that, especially for the medium to larger companies that now spend almost 15 or 20 pages of the 10K that describes how the executive compensation works. And you start to realize one of the things that's starting to happen is there's a bigger and bigger weight on long term.
Right.
And less. So the long term could very easily be on a 3-year basis 4 or 5 times base salary if you hit target compensation. And the whole point of doing that is measuring over a longer period.
Last question I'm going to ask you is a tough question. I've written on it, so I know a lot about it. So companies that use earnings per share, a lot of companies use quote-unquote adjusted earnings per share, meaning they take the GAAP earnings and then they decide, well, I didn't really think this expense, I should take it out because it was restructuring or this was some sort of stock expense. And so we found in our study that of the S&P 500, 100 of the companies, their adjusted earnings were 50 to 200% higher than their actual earnings.
I've had situations where you can actually see that, where you look at the adjusted EBITDA, which they would be showing, and it'll show all kinds of performance improvements, and you actually look at the accounting GAAP statements, and they would be having a loss. So you said, how did you go from a loss to somehow looking like you're doing very, very well? So those are
I think
key.
there are legitimate reasons for doing some adjustments, especially like foreign currency and if you have a merger, et cetera. But some companies have gotten very carried away.
Right. I totally agree that
Okay.
it
So
needs to be transparent.
We have, I think, 10 or 15 minutes left, and we really want to use the wonderful expertise we have in talent from the panel to get your questions. So I'm only going to ask you one ground rule. Ask the question, don't make a comment. Don't give a speech. Yes, sir. Yes.
Yes.
Okay, I think we're not going to have Mike just speak up.
I have some experience with boards too, and it looks like the CEO, if the current result is good, it's his, responsibility. If it's bad, there's a strategic plan that in 2 years is going to be good. So at the end, it becomes like an exercise where everybody's trying to beat everybody else's expectations. So my question for you is, you guys have a lot of experience in boards. have you developed some skills or tricks to navigate through all this mess of you? Because it's the annual report, the strategic plan, and the performance. But
Okay, does somebody want to take that?
Yeah, I think it's what's most important is being engaged. One of the big challenges that all directors have is if you don't know that industry and you just became a director, as Bob said, it takes you about 5 or 6 meetings before you actually start to understand what the challenge of the company is. So one of the things that I think that's very important is every one of those meetings trying to understand the business better and better than you did from the previous meeting.
I also want to say that, to me, the acid test of executive comp is how are the executives treated when the company isn't doing that well. It's easy to have great rewards, but the question is, does the board have the courage to say if the company isn't doing that well, and it's attributable to the CEO, about having downside. So we see less, it's asymmetrical, less willingness to get downside comp versus upside. Let's have some other questions. Yes, sir.
Do you see board members assessed as proactively for their performance as the management?
Okay, so maybe Sally could answer this board evaluations, self-evaluation.
So we do self-assessments as to how the board is performing. And so is it as extensive as the CEO assessment or the senior management team, the C-suite team? Probably not, but we do take a survey and make sure that both in committees and on the board in general, and get feedback from the various directors. Do they feel engaged? Do they feel heard? Are they getting the materials they need to prepare for the meetings? What more do they need?
But here's the tough question. Boards are pretty good at evaluating the committee's board. Does your board say which director is not pulling his or her weight?
Yeah.
Is there an evaluation of individual directors? My experience is that rarely happens.
Can I comment on this? Bob?
Sure.
So I chair the Nominating and Governance Committee for Citizens Bank. And one of the things that we've come up with that is starting to work well is there's several levels of board assessments. As Sally said, the first level really is how does the board think it works among itself? Second is how does the board think how each of the committees work? But then we have a specific third level, which we've now done for 2 years in a row, which works where we use an outside consultant, and the outside consultant actually interviews each of the directors and has the director's assessment how each of the other directors' performance has been and what value they've been adding.
Yeah. And that is
been very useful.
Unusual. That is
That's been very
unusual.
useful. But we use an outside,
Yeah.
we don't have anybody from the company involved in that. It's an outside director.
And Shivan, what do you do with that information?
I
How
have-
is that?
Let's get another, yes, sir.
I have a question about chairman and CEO. Since those are two different roles, what do you think is
Well,
it
here's
to
the
have two
factual,
different roles in one same person?
Yeah. Here's the factual basis, and then people. So in many countries other than the US, the chairman of the board has to be an independent, cannot be the CEO. In the US, roughly 25% of the boards have an independent chair. But in the US, when the CEO is the chair, which is most of the time, there's an independent lead director, and some people would argue that he or she plays a similar role to the independent chair. Now, I don't know, Felix, do you want to,
Yeah.
from the Asian perspective, do you generally have independent chairs?
No, so I'm based out of Taiwan, and Taiwanese regulation basically says, chairman, you are responsible for all legal activities of the company, right? So if my company does something,
You are effectively the CEO?
So you're effectively the CEO because you're responsible for everything. So, in that case, I want to be the chairman and CEO instead of
Yeah, well,
just
you're
the chairman,
responsible for everything.
right? Because I'm responsible for everything, right? Something goes wrong with my company, I go to jail.
Yeah. But if we look at the UK,
But I
Canada,
am
Germany,
100%
yeah.
for chairman not being executive, and that chairman it separates from CEO.
Okay.
So this is odd, right? Because I am chairman and CEO, but this is only because of where I am.
Well, he's responsible for everything. Yes, sir.
Bob, when you introduced Shivan, you mentioned that he'd been looking at comp measured by CEO versus median.
I didn't mean,
No, we haven't gotten
I
to
was
that
just,
yet.
I was
Yeah.
saying, that was a point of controversy,
Oh.
that we now see lots of journalists who are writing, because we have all this data now, saying certain companies have high ratios, meaning the CEOs say 400 to 1, and other companies are 200 to 1. And just my take is that's not very meaningful information, because if you look at a company like Goldman Sachs or Google, actually the ratios are relatively low because they tend to pay a lot of middle-level
Exactly.
people high. If you look at retail, they tend to pay people, they have lots of people who are in the stores who aren't making that much money. Moreover, the SEC in its methodology said you're not allowed to analyze people who are part-time. So in retail, you have lots of people who are seasonal in this, and you're not allowed to analyze. So I think that data is highly suspect. Yes?
That's kind of prologue to my question, because I do recall an article in the Wall Street Journal some years back where a couple of the staff journalists looked at the 10Ks of all 500 of the S&P 500, and their analysis looked at the total comp of the C-suite, so to speak, all of the execs reported in the 10K, divided by total comp for the firm, and the numbers were, to me, astonishingly high. I found it much more surprising than a much more rifle-focused, laser-focused comparison of the median versus the CEO.
Well, I think you're probably right to say if you took the total comp of the top 5 officers, which are reported in the proxy statement, the 10K, and you compared that to the total comp of the employee base, that'd be a better ratio. But you still have all these methodological issues about international employees, and we've seen some really perverse results. Some companies said, okay, we're going to outsource our whole janitorial staff, so they won't be in our employee base. So you get some crazy sorts of things that happen. But I agree, that would be a more indicative. I think that Shivan was suggesting CEO focus is too narrow.
I want to add, I think this pay ratio issue, the impact is more that people in the organization now are looking at that median income and saying, I'm paid less than that, or I'm paid more than that. And so it behooves every organization to make sure that they have good job descriptions, that they're, comparing them to the market, and they're paying people fairly and effectively relative to each other, because it's raising questions amongst that group.
We have time for a few more questions. Yes, Miss?
Yeah, I had sort of switching topics, a question about, I guess, standing your ground as an independent director. And I have an experience where, obviously, on the financials, you may get pristine numbers, but pushing underneath on some of the operational metrics or key metrics that you think are really important indicators of performance or may set up indicators about problems to come. When you feel strongly about something, but it's not clear that other board members are jumping in, and you're pretty dependent on the way the executive team shares that information. I wondered if any of you had had experiences like that and could share some how you handle that.
Well, Shivan, do you want to?
Yeah, that's, it's more common, especially in companies that's going through a bad patch.
Fast growing.
Or fast growing, exactly, where, and a lot of times the other directors are not operating people or people operating backgrounds. They tend to be more the investors, They represent the, either the private equity owners or wherever they are. And that's always been a challenge. And the only thing that that works is that you keep saying the same thing again and again and again until somebody hears you. Because
I think
there's not a lot of choices to that, other than just keep pointing that out again and again, and then you become a pest.
And this goes to the respect
Yeah.
that directors have for
Right.
each other. So if you've got the, operating background and others don't, you need to have some offline conversations with them and say,
Yeah.
I see trouble coming here.
Yeah, I
And
think that's
here's
a,
why. So directors talk to each other outside the boardroom
Private.
too.
that's a key. My experience is that you can't be a lone ranger. If you want to change things, you've got to get at least one other ally, hopefully two, and you do that offline. You can convince 2 or 3 people, then you start to can make an impact. Let's see, other questions? People that haven't, yes, Miss, sorry.
Relative to a comment, Sally, you made earlier, in your career, you started on nonprofit boards and eventually moved over to corporate boards. If you were a person who was at a point in your career where you've had a lot of experience, had some experience with nonprofit boards, and you'd like to become more on corporate boards, how do you signal that that's what you'd like to do? We've heard how everybody here looked to source board members, but when you're in the position of saying, this is something I might be interested in, how do you strategically and,
So.
make that known, I suppose?
Okay, so a couple thoughts. One is there are organizations now trying to help people who want to get on corporate boards. I mentioned the Boston Club in Boston is one of them for women. And, there are other organizations that are, dealing with diversity on boards, also helping individuals try to get their names in front of people. So that's one way, but networks, your networks, reach out and tell people that hey, at male, female, next door neighbor, someone at the soccer field, whatever, hey, I'm looking, don't be shy. I mean, I think sometimes we don't go forward and say, hey, I can do this. I've got a lot of good background and I would really like to find a corporate board that I could be on. So network.
I'd add 2 more points. One is all the companies have their board of directors on a website. Go and look at the website, see if you know anybody. And then that will give you somebody you can talk to. And often the lead time is 2 or 3 years, so you need to do that. The other thing is most boards don't have enough people with the expertise and willingness to be on the audit committee. So if you're head of the
Nobody wants
audit
to
committee
either.
of a big nonprofit, that's a good way to get people interested. So I think we have time for one more question. I don't know, we have somebody? Yes, sir.
I'd like to hear the second part of Shivan's story about getting the external body to evaluate the board and then what you.
Okay.
I'm sorry.
Thank you.
I'm sorry, what was the question again?
You didn't finish the story, but we do.
What happened when you had the external, what happened?
It falls on the chair of the nominating and governance for a person to actually go have that dialogue with each of the directors and point out to them as to what some of the other directors think and where they might want to focus on how they're perceived or how they're viewed, or sort of start to work on it. You just have to do that. And I've done it now twice, 2 years in a row, and you start to get better at it. The challenge you have is you can't sugarcoat it, because the evaluations are hardcore. This right there in front of you. The one thing I have done is I share the whole document with the director in question, so they see all of it. So it's not like you're shading it in any way.
So you had a case that was a non-performing director.
Right. Yeah. So you work on that.
So we're now coming to the end of our time. We're actually over time a little, but we apologize for moving through the material quickly and being a little abrupt, but we're trying to get everybody have a chance to make input. The panel will hang around if you want to ask some more questions, but let's give them a big hand. And